planning to retire in 2022, what are some tax-centric financial planning strategies you might consider? Well, here to talk with me about this is Patrick Kuster from Buckingham Strategic Wealth. Patrick, welcome.
Thank you, Bob, and thank you for having us again.
Pleasure. So what are some strategies that folks need to consider?
Well, I think we start by figuring out where we are now in our plan for 2022, right? I think if we're thinking about retirement, then I'm going to assume we haven't retired yet, right? So for someone who's thinking about retirement for 2022, I think we have to start looking at where we are and making some decisions based on maybe some of the benefits we have. As an example, usually employees are contributing a percentage of their income, right? If we're only working for, half the year, we might have enough income to satisfy a larger retirement contribution, or we might be eligible for a larger contribution, but based on the current contribution percentage, maybe we didn't make it. So things to consider are maybe we're going to up that percentage for a part of the year to make sure that we're maximizing the contributions and the deferrals for 2022 before we retire. Another point of that is also, it's kind of a little interesting, but for someone who's past the RMDs or an RMD ages, if they retire mid-year, they might actually have to take retirement account dollars that they may not want to. So if someone's retiring at the end of the year, maybe they want to take that last week of unpaid sick time and retire in 2023 from a technical stance. I was going to say, Bob, there's also some interesting or intricate rules around things like HSAs, health savings accounts, for those that are eligible and contributing. I'm going to say take an eye or take a peek on that and spend some time with your financial advisor or with your tax professional, or really around eligibility, right? Sometimes with those accounts, employees may front load or make larger contributions earlier in the year, but you might not be eligible for the normal contribution amount if you're retiring midway through the year.
For folks who are 65 and have to enroll in Medicare, there's other complications too if you have an HSA?
Oh, there's definitely other complications if you have Medicare and you're enrolling in Medicare. I'm going to pause and say the rules get very involved here. So some of the considerations have to do with if you're working past 65 and the size of the company, right? So if you turn 65, let's say January 1st, 2022, and now you're enrolled in Medicare Part B, there's potentially some concerns there. If the companies are large enough, which is defined as more than 20 employees, I won't get into the intricacy of that definition, right? But the point is, it may or may not impact you depending on the company you're working at and when you're retiring. So chat with your tax professional, I'll say, and/or with your financial advisor around all of these things if you haven't already and you're turning 65 this year.
What about folks with highly appreciated company stock in their retirement plan?
So this is fun. So highly appreciated company stock and retirement plan, right, also requires some intricate rules, right? So I'll pause and say, Bob, the intricate rule things that are definitely in the article that we wrote about, I will say, right, is HSA. NUA is what we're talking about here, opens up another can of worms, depending on what's in there and how much it's appreciated, how much it might appreciate. But here's the point. High level, again, as we mentioned earlier, let's just try to do this. Let's say if you've got company stock in your retirement plan, it either has appreciated a lot or you think it's going to. It's a really good time to sit down with your financial advisor and tax professional to figure out strategies around taking those dollars out. And specifically, where there's potentially an opportunity there is, let's say you bought company stock at a low amount. I'm going to make up a number, $100 a share, and now it's $1,000 a share. There's potentially a way of taking those dollars out and paying capital gains on the growth instead of income taxes. But as I say that, again, there's special rules and special things that need to be done. So it could make a ton of sense for someone who has that appreciated stock in the retirement plan, but we've got to be careful and make sure it's executed the right way.
Another strategy to consider is harvesting losses, even though it might sound like something that's contrary to what you might want to do.
That is fair, Bob. So, and I'm also going to say, Bob, if depending on when we invested in the things that we have, we may be showing some significant gains or potentially losses, depending on whether this was an investment from, I'll say, pre-pandemic times or late last year. But yes, in a year where someone's retiring, depending on their income and how their income is going to project over the next few years, right? I'll tie back to the article and say, trying to segment this a little bit. For someone who's in potentially one of the higher income tax years, now potentially through their retirement, this might be the right time to try to take advantage from an efficiency stance of trying to defer taxes, when we might be able to choose to pay those taxes at a lower rate later. So getting back to tax loss harvesting, if you've got positions, which sometimes might not be the entire position, sometimes it's when you're repurchasing shares from dividends. If we've got some positions that are significant enough that we want to act, the goal of tax loss harvesting is to take those things that now have losses and to sell them when they're down. Everything against what we've ever heard, Bob, right? Buy high, sell low. That doesn't make any sense, right? But yes, we're saying buy high, potentially sell low, so Uncle Sam knows about the loss, but then turn around and buy something that's close but different, right? This could be selling an ETF and buying an actively managed fund that's, again, similar in the sense that we're going to try to get the same or capture the same recovery, but different enough that it's not exactly the same.
What about sequence of returns risk? Is that something that folks who are retiring this year need to worry about too?
Absolutely. And I will tell you from personal experience, I have found that people in general are showing more signs of anxiety, right, and concern, not just with markets. I mean, look, we're literally at a time we're talking about pandemics and we're talking about wars overseas, right? While markets have been showing really high signs of volatility, right, amongst other issues like inflation, right? So as we talk about sequence of returns risk, what I'm going to say is there's 2 points here. The first point is that large losses in the beginning of retirement can have a substantial impact on the amount of expected growth and really income throughout retirement, right? So that's kind of a deep comment. But as I say that, I will also tell you that given the current environment, given the extra stress, it's also important to be aware of how we're going to react or how we might react if we saw a large loss in our portfolio today. And that's really an emotional comment, right? That's the 2008 stories where markets came down, people sold, they entered into retirement, and then they decided they had to go back to work because they couldn't afford it, right? So there are things that you want to take a look at here. And again, Bob, to answer your question, it's a matter of being focused on understanding my income needs over the next really 3 to 5 years and understanding the actions I would take if markets were down. Those actions could be saving a little bit more or putting a little more in preservation on my anticipated near future needs. I gave an example in the article of needing 10% of your portfolio as opposed to 1%. Right? That's step one. Step two is, let me figure out whether or not I should take dollars from somewhere else if this significant downswing happens. Do I want to maybe take things from a loan as opposed to actually selling off my investments? Right. And as I said, also in all of the consideration here, there's got to be a consideration as to how am I going to react and make sure that's in check, because we don't want to have things go down 30, 40, 50% and then us sell because we just can't stomach the ride anymore. Right, so sequence of returns risk is definitely something to consider. And I think that's something to consider is irrelevant of whether we're in wars or in periods of high inflation. We're going through a pandemic. I mean, we can't predict markets.
Right. One of my favorite topics is sometimes referred to as asset location. That yet another important strategy to consider for future retirees.
Absolutely. And I'll say, Bob, we've also had a deep conversation around this. So I'm going to pause and say, anyone who wants to go even deeper, I can tell you the street definitely has articles on this, and one that Bob and I have recorded to a certain extent. Here's what I'll say about asset location as you're entering retirement. Potentially, this is the time, depending on the age and the income, and I'll say your plan with your financial advisor and tax professional again, Bob. But this might be times of thinking about Roth conversions and where you're going to take money from. Right. So as we look at asset location, this is the time to go back and say, hey, maybe I should not reallocate how I'm invested. Not talking about the percentage that you own necessarily. What I am saying in asset location specifically is you might want to make decisions on where you own things from a tax perspective and also from an income need perspective, right? Going into retirement. A good example here, tax inefficient things are generally prioritized to tax inefficient type retirement accounts, such as pre-tax 401ks and traditional IRAs, where tax efficient, higher expected return investments are typically prioritized to things like brokerage accounts, or we start looking at the Roth for higher expected return. Every client situation is going to be a little bit different. So I will say, take a look at that and think about those things that you're looking through your asset allocation, and you're making those decisions around buying and selling.
So in the article, you talk about some time-honored advice about reviewing beneficiaries. We're running short on time, but so I want to jump ahead to some age-dependent actions, if that's okay by you.
Absolutely. So I'll say this: reviewing beneficiaries, I will always say, is not age-dependent, right? Specifically, it's always a good time to review them. But I can't tell you how many times people are retiring and they haven't changed their beneficiaries from when they started working there, right? So it's a really good time. I'm not saying that because you're retiring, you should check them. I'm just going to say, hey, you're going through retirement. While you're there talking about retirement benefits, take a peek at the beneficiaries. As far as the other age-dependent actions, I tried to group these up into really 3 segments, right? Like before 59 and a half. Why? Because before 59 and a half, there's potentially penalties, taking dollars out, and potentially strategies to take retirement income out of pre-tax accounts without having those penalties. And that's through substantially equal periodic payments mentioned in the article, right? We'll expand on it there. There's also some things to think about before 59 and a half, such as if you're going to be rolling over from a plan, was there options to take dollars out from the plan without incurring these penalties, because rolling them over into an IRA may remove some of those benefits. So just be careful and be cognizant as we're making these decisions around things like rollovers. And again, the big question for someone before 59 and a half is, where am I going to get my next paycheck from? For those that are past 59 and a half, we get rid of some of those penalties, and potentially we're not as worried about where we're going to get income from because we have more options, right? We might be able to turn Social Security on as an example. Certain pensions will trigger during those ages, right? Where maybe they didn't have the option to take the pension earlier. The 60s for me are the ages of, we want to be very, very aware of our decisions around taxes and Medicare, right? These are the ages. These are the prime ages usually for looking at Roth conversions, for keeping an eye on AGI, adjusted gross income, and Medicare costs, right? And really digging into, again, that tax efficiency. Again, we have more flexibility generally in these ages. So income planning here is important, again, really from a tax-centric financial planning perspective. Once we get past the 70s or into the 70s, we have new options and new requirements, right? We have required minimum distributions that kick in. Potentially for those that are working or not working, depending on whether they have IRAs or they have an ownership in a company that might be significant enough to reduce or to eliminate the benefits of being able to go past 72. And as we think about these requirements in the 70s and kind of tying back and taking a step back to the 60s, for someone who may not need to take the RMDs down the road, if they're not anticipating income needs, that's a prime reason to evaluate Roth conversions. Now that we're in our 70s, 2 things we want to look at specifically: QCDs, qualified charitable distributions, and making sure that we're satisfying RMDs, right? QCDs just being the option of, hey, if you're charitably inclined, if you're giving money to charity, when you get past 70 and a half, you have the option of taking dollars out of your pre-tax IRA and giving them directly to charity. There's extra intricate rules here again. So I'm going to say it's got to go directly to the charity. Don't ask for the free mug in exchange. Certain custodians might give you the ability to write that out of a checkbook. So for those that maybe are giving to a religious institution, makes it a little bit easier. For RMDs, 72 is the new rule. So the year in which you turn 72, money's got to be taken out. You get to decide that first year if you're going to take it out that year or up until April of the following year. But generally speaking, you're going to want to take them out every single year, starting with the year in which you turn 72, so you're not lumping. With that said, if you're retiring in the year in which you turn 72, then we've got to make those decisions, because you might be better off deferring to the following year on that initial required minimum distribution, just again to try to level out some of your income.
Well, Patrick, we covered a lot of ground. We've helped a lot of people. Anything we missed or anything that bears repeating before we wrap up?
No, I don't think there's anything we missed from the article, Bob. I will just say this. I think the last couple of years, and specifically this year, there's anticipated new rules and new guidance, both in terms of acts and in terms of proposed regulation from, I will say, Uncle Sam, right, from the IRS. There's recent regulation that was proposed surrounding 10-year rules on IRAs and specifically for inherited IRAs. So what I will say is this, Bob, the one thing that I don't think we said today on the recording is, as we enter 2022, this is another year that I would say it makes sense for most to keep track of what's going on in the regulatory environment to see how that impacts you. It may adjust some of your planning for the year and potentially for years to come.
Well, Patrick, as always, thank you for sharing your knowledge and wisdom with our readers and our viewers. It's greatly appreciated.
Thank you again, Bob, for having me. I appreciate the opportunity to share the knowledge with the world.